to bring you today Brendan Ahern, Crane Shares, the evolution of passive asset management. Some fascinating discussions we'll have today on the evolution of financial management products within the passive universe, especially emerging markets with China, the Fed, and the dollar. I mean, today was a big day with the Fed meeting, so we're going to add a lot of value. Stay with us. But first, I want to bring in Brendan. Brendan, what really impressed me so much over the years, we've been friends for years, and but for your career to be there on the ground floor of Barclays, and then moving from Barclays, and when obviously BlackRock came in and the companies merged, that was really the passive revolution, that passive asset management. You're talking about $2 trillion has moved into the passive universe in the last 7 or 8 years, and I think $1 trillion of that was acquired by your team on the Barclays BlackRock days, and then you parlayed that into Crane Shares, and now as the CIO of Crane Shares, which we can get into next. But just talk about your experience. It's I think so inspirational, that experience being on the ground floor, in the passive, and how you felt. I mean, did you really feel when you were in there in those early days at Barclays Global Investors? Did you in your wildest dreams imagine that $2 trillion of new capital flows that would come into passive in the next 7 years?
Well, no. I mean, I think when Barclays Global Investors was a big institutional passive quantitative manager, really, BGI kind of founded index investing. They just didn't do it for retail investors. They did it for pension plans, and they just never had mutual funds. And they got into really, I think, blazed the trail in growing the ETF business with their iShares business. And I just fortuitously got hired by BGI during the rollout of iShares. I moved from New York to San Francisco. And we were a startup within, we had this kind of rich uncle, but we were in a different building. There was only about 24 of us. I mean, I was the most junior person. I was probably one step above the janitor. And I was amongst these kind of captains of industries. We had this great leadership team, people from Fidelity, Prudential, all big firms who came in to be part of building the business. And again, I was probably by far the most junior person. And it took me a while to realize that, if this doesn't pan out, they're just going to unplug this little satellite office in San Francisco. We were down the block from the mothership. We were on Market Street. The rest of the company was over on Fremont. But it really did take off. And I think, most investors, we all have favorite investment books. And, if it's reminiscence of a stock operator or Jack Schweiger, your book, Larry, on Lehman, all these great books. But, growing up in this passive world, really, for me, the seminal book was always MSCI's Global Investable Markets Index Methodology, that this book dictates what ETFs own, what index funds own, right? That the ETFs and index funds don't control what they buy and sell. The index providers do. And, we're going to see that with, Tesla on Friday going into the S&P 500, right? 3 of the 4 biggest ETFs globally have never owned a single share of Tesla, right? And so, to me, MSCI has always been the most important company in finance, because they dictate 12 trillion of both active and passive assets. And every investor should have their index methodology on their bookshelf.
Let me just back up for a second, because I want to get into Tesla. And the integration there. But for the investor watching us right home right now, there's all different types of investors. First of all, this is not financial advice, and we'll bring out our disclaimer here. But This is just a couple of friends having a chat about the business. Here's the disclaimer. I want everybody to read it. This presentation is for educational and informational purposes only. It has been compiled and arrived from sources that we believe reliable, and we make no representation or warranty and express or implied that it's should be viewed as completely accurate or complete. This is just a conversation between two old friends in the business. But just to get back to when I started my career, the active asset managers really ruled the land. And Peter Lynch, and one of my favorite books was One Up on Wall Street. That he wrote. And my favorite line from that book is, he really pounded this message home. The stock that you should fear the most is the hottest stock in the hottest sector. And he would really try to stay away from the hot stocks. And back then, all the assets in mutual funds and the asset management industry were in active management. And all that means is that you have a portfolio manager that is running the portfolio, and he's choosing the winners and losers, stocks that he doesn't want, he's selling, and stocks that he wants to own or she wants to own are buying. Whereas the passive revolution really came down to picking a group of really thoroughbred horses and riding those until you change. How often do from what I can see, isn't passive active asset management becoming a little bit more active in recent years? Are there many changes in some of these portfolios?
I think you have different camps within passive evolving. You've got, an MSCI is a very quantitative, replicable strategy. Within that index methodology book, you can replicate exactly what they do. Very similar with, say, FTSE. You then have someone like S&P, S&P 500, it's a committee. And, I think with Tesla, that committee added Yahoo. They kind of rang the bell for the .com bubble, adding Yahoo. And I think that is why it took so long for Tesla to get added, that no committee ever wants to be embarrassed. And, Tesla, has some hair on it,
well, let me get into this for a second. So Tesla's coming in with a market cap close to 700 billion.
Yeah.
And so it would be in the top 7 holdings. But what a lot of people don't understand is, walk us through like the XLY, for example. Walk us through the broader implications here. The XLY is the consumer discretionary ETF. And so that ETF will take on Tesla as well. And the problem there is it's so big. It's Tesla's big, right? But when we bring it into the S&P 500, that's 500 stocks, right? But when you bring a piece of Tesla into an XLY, which is the major consumer discretionary ETF, isn't that a little bit more disruptive to the process?
Well, one, to get Tesla in, you have to sell everything else. And so there's talk about, is what you're seeing in terms of some of the consumer discretionary names being a little bit weak, because what passive managers will do is, technically they have to buy it at the market close on Friday. And so for fun on Friday at 3:59, watch Tesla, because you're going to see these massive blocks go through. Now that's the passive managers. Now the passive managers, are not dumb. So they're going out to their brokers, or they've already done this and said, we need to buy X millions of shares of Tesla at 3:59 on Friday. You go out and buy it, and today or last week, and we'll buy it from you on Friday. So all of this has been kind of set up where the big index fund families are working with their brokers because they're not buying all of these shares. Yeah, I mean, none of it's going to get bought in the open market. It's kind of an over-the-counter trade between the two. The fun thing for me is, I kind of call it the power of passive on display, is they do have to print those trades. And so at 3:59, 4 o'clock, 4:01, it's going to be a fireworks show. And, we all kind of know who the big players are. And, for fun, you can kind of say, hey, I know who that share went, that block went to one firm. Here's, you can kind of back into it just based on the size of their funds. But, no one's buying Tesla in the open market. It's an agreement, working with brokers and to try to not to impact it. Lehman, you might remember this, Larry, was very big in saying, the stocks coming in and out of, say, the Russell 2000, right? How do you game that? You go long the addition stocks and you short the deletes, but over time, like, those trades started going the reverse, and it's an element of the passive players getting smarter, but also enough market participants kind of figuring this stuff out.
And I noticed this week the weakness in Amazon, because Amazon, people forget, is 20% of the XLY. It was 21, 22. So in that case, you're bringing Tesla into the consumer discretionary ETF XLY, and there's a lot of selling that has to go on in Amazon to fit that in. So for people at home watching these right now, this is some of the fascinating dislocations that we're seeing in the market today. Warren Buffett, who Charlie Munger invited me out to Omaha a couple of years back, and I got to meet some of the Berkshire team. One of the things that Buffett talked about was when they brought Berkshire in, it was one of the largest stocks ever to enter. I think it was at the time one of the largest stocks to enter the S&P 500. And he had some different theories about the way to do it. One is to do secondary offerings, and that's what obviously Tesla's done 2 of them now, 2 $5 billion offerings. And another way would be to scale it in over the course of, say, a year with different slices. But these guys and gals at the S&P have a lot of courage to try to take this thing in one fell swoop on Friday at 3:59. But let's get back to Crane shares, because that's the evolution of your career and what you built and all that experience on the passive side, and from going from Barclays and then BlackRock and then now over to Crane. So you were basically to start a Crane. The Crane team kind of saw this passive evolution looking more global, right? Because you saw the passive revolution in the United States. So all this money's coming into index funds like the S&P 500. And was the theory there at Crane, okay, let's get involved globally because MSCI has to absorb a lot of these equities in Asia. Is that kind of the theory behind it?
Yeah, our founder, Jonathan Crane, went to China in the early 2000s and built a successful business geared to China's urban consumers. So, he witnessed firsthand, living in Shanghai, how the economy was evolving away from export-driven manufacturing to a domestic consumption economy. He also saw how China was opening the door to foreign investors for the first time. First foreign investor was allowed in 2001, but that slowly, very quickly expanded. So ultimately, John sold his business to a U.S. multinational, comes back to New York in the late 2000s, sees how much the ETF industry's grown, but when he looked at China, it was all old China from the China ETFs and the China exposure in emerging markets. It was all financials, energy, industrials, materials. There's no new China. There's none of this domestic consumption story. And then the definition of China was only Chinese companies in Hong Kong. So he started down the path. He's a real cerebral thinker, and started down the path of creating Crane shares. And I got introduced to Jonathan fortuitously through a friend. And when he articulated that you had Shanghai and Shenzhen stock exchanges taken together, the second largest stock market in the world, but it wasn't part of any index, and how China was allowing more foreign investors in, I just said, today MSCI has $1 trillion benchmark to MSCI emerging markets, active and passive. And if you take the second largest stock exchange in the world and add it to these, $1 trillion of assets, I was just like, man, there's a lot of money. And if we can get there first, wouldn't that be great, right? If these passive people have to buy what we already own. And so I quit my job and in the beginning of 2013 to help make, John's vision investable along with my colleagues. And, certainly Larry, we were, I give you a lot of credit. You were a very early supporter and understood what we were doing. And, it took the market some time to kind of figure out what we were up to. But, we started the business, John's gumption, his foresight, his vision, no clients, no assets, no brand. And today we manage, about $6.5 billion on behalf of our investors. And it's just been, for myself, it's been just, very rewarding experience. And, have to, again, I'd give you a big hat tip for your very early support, as for any entrepreneur, you have these kind of dark days where you're struggling, and you always were there to give me like a little bit of the Vince Lombardi speech, and you kind of stuck with us through thick and thin, and I think it speaks volumes to your character.
Segue to my vision, essentially, the bear trap support. We've had this as our team's vision. Is we had this decade that you just went through, and think of what Crane active and passive management companies in Asia. You had in 2013, you had a Federal Reserve that massively misjudged the impact of the taper. So the Fed was doing a lot of quantitative easing in 2010, 11, 12. The way they kind of forecast the taper and the speed at which they basically underestimated what would happen if you taper in 2013 relative to the rest of the world, because the rest of the world was in pretty bad shape in some respects, especially, Europe's coming out of this Greece problem and austerity. So when they announced the taper, I'll never forget, it was this May of 2013. I had dinner with Jeremy Stein several months later, and he had left the Fed, and he told me when they wrote the original, not a press release, but it was probably one of the Fed speeches where they were going to announce it. They read it like 15, 20 times, and they thought, okay, the market can handle this. But at the end of the day, the market couldn't handle it. And the Fed really blew up the emerging markets in 2013 for that year. And that was your launch year. So you had to go for that. You talk about the dark days. And then 2015, the way they were forecasting, not just, they had to, number one, they had to do the taper. So they had to taper, they announced sleds. All that means to the person watching us right now, let's just say you're doing $60 billion a month of asset purchases, and you want to take that down to $50 billion or $40 billion a month, that's called a taper. And it has a huge impact on gold, emerging market equities, because it's stealth tightening, and it's a lot more tightening than people thought, because of its impact on other central banks. And then in 2014, 15, they really made the same mistake again. They looked at the Phillips curve, in which today the Fed is really, Jerome Powell today, which they've done over the last year, they've really embarrassed the Phillips curve, but they basically just thrown in the towel on the Phillips curve. And all that means is, looking at employment, impact on inflation, and that's going to give you a certain speed at which you try to exit from your central bank policy. And so in 2014-15, they basically told Wall Street that we're going to hike rates 14, 15 times over the next couple of years. And that's the same thing as a taper tantrum. They created again. The dollar strengthened so much in 2013, so much in 2015 that they blew up the global economy for the second time. And China had to devalue their currency, and you had to go through that. And then the next year, you had a Brexit, and a Brexit problem. The problem with the Brexit is, you're creating a major economic strain in Europe, and that just brings more money, more capital into dollars. That's once again another challenging thing for Crane to raise capital during a Brexit, a taper tantrum, and a Fed that's trying to exit rate hikes, and then you had a trade war, and so now we've gone through tapers, we've gone through rate hikes, we've gone through Brexits, we've gone through trade wars, and so for Crane, my God in heaven, for Crane, for your company to raise $6 billion since 2013 in that environment, I have a very strong feeling that in the next 5 years, you'll probably triple that in terms, because I think at the end of the day, if you listen to the Fed today, what the Fed just told you is everything they did from 2013, 14, 15, 16, and up to 2018 with obviously trying to pound the table with the balance sheet. We're going to do 50 billion a month of balance sheet reduction. We can do it. They told the world they could do 2 trillion total of balance sheet reduction. It was a complete, I was a lie or a joke, but they massively misjudged that impact on emerging markets. And now the reason I bring it up is today I think it's a historic day, because you had a Fed meeting today. They pounded the table. That as far as the eye can see, they're not going to make that mistake again. Yeah. And walk us through. I delivered a speech in Asia a couple of years ago, and there was one of your competitors was there on the active side, and he said, and this was during right after the taper tantrum, and he talked about how when he I think we were in London, and he said, if the room is empty, in other words, this was a big emerging markets mutual fund, because if that was focused on China and Asia, because if the room is empty, it's probably a good thing. That means our funds buy. If I look at the KWEB, in other words, when KWEB, when we were going through the trade war, remember everybody in 2018, the fourth quarter, you had the trade war and you had the Fed going crazy with rate hikes, and you had this big this G20 meeting that was going to supposedly solve the trade war. And I remember Crane, the KWEB, which is your big internet fund, was really for sale. And walk us through, like, when you see those asset flows, for investors watching us home right now, a lot of times they're phenomenal contrarian indicators, right? In terms of when you're seeing the asset flow outflows peak, it's probably a really good buying opportunity.
Yeah. I mean, I think emerging market investing comes with volatility. That's part the name of the game. And but I think our core thesis around, say, KWEB, this idea of domestic consumption as it occurs online, that's not going to change. And when we see periods of volatility, I think for investors with a long-term time horizon, it's been a great period to enter. And I think we've kind of found that sometimes these headlines, it could be political rhetoric. I always check now CNH. So CNH is the renminbi during U.S. trading hours, and equities, we know, are they move very, very quickly. Now, part of this is the rise of high frequency trading, and but in theory, any one of us can move Apple stock. If I sell, that trade gets put on the tape. But the FX market is very deep, it's very liquid. And whenever I see one of these headline goes by where, it feels like Armageddon, I always pull up CNH, because it kind of tells me, is there any bite to this bark? And that could be a tweet, it could be, a headline.
Let me bring you back. So what you're talking about right now is a phenomenal risk analysis indicator. So think of 2019, 2018, 2019 versus 2020. Every single Trump tweet in 2019, in terms of trade, in terms of the potential additional tariffs, in terms of 5G and restrictions on China, every single tweet, almost every one of the major tweets that he did was received with CNH or CNY weakness. And I'll never forget the night we crossed 7, the 7 handle. That's for our clients. We have a Bloomberg chat with basically the Bear Traps report is made primarily an institutional product. We have a live Bloomberg chat with about 600 institutional investors around the world, and they were all watching CNH, CNY, the Chinese currency, foreign exchange. They're looking at that 7 handle. We went through it, and that is so the point is that as the headlines were coming out, that CNH and CN weakness, whereas this year what was fascinating is you had some pretty scary headlines and pretty scary tweets over and over again. And you and I were talking in the chat live, that next morning or overnight, and you have a blog called was it about China Last Night?
Yeah, ChinaLastNight.com. Yeah.
And you were getting into in the ChinaLastNight.com, you're getting into the strength in the Chinese currency, the strength in CNH, the strength in CNY. So, I personally look at CNH vol. So one thing you can do is track CNH, the currency itself, but you can also track the volatility. And that means all that means in English is people making option bets on the currency and how much those bets are priced at. And that gives you an indication of speculation coming in, either people that are betting on a bearish move or a stronger currency or a weaker currency. But this year, you must have felt pretty good, because as the Trump tweets were coming out, CNH was strengthening. And tell me, what has that done for fund flows?
Yeah, so you had this almost inverse correlation. When you look at KWEB and CNH, that as the dollar has deappreciated, the renminbi's appreciated. It's provided this real tailwind for KWEB. And just to your point, Larry, when we went from 7, broke 7, and got close, up just about 720, and people were calling, it's going to 750, it's going to 8, it's going to 9.
It must have been 75 8-handle predictions.
And the exact, and what would, so we went from basically 720 down to, we're just around 651 right now. So it's been a great indicator. We try to tell investors, like, this view around China's domestic consumption story. It's not changing, but there's going to be peaks and valleys. And using CNH, you can kind of gauge when, candidly, sometimes you might want to take a little profits off the table. There's times where you want to add, you want to rebalance back in, and I think we've tried, particularly this year we've had some tweets or some headlines that, to me, they scare me a little bit. But you see a positive CNH reaction, which tells us there's no bite to the bark, and we don't want an element of our investors to get shaken out of a trade. And I think about in April and May, you had some very negative headlines. The Senate passed a bill to delist U.S. listed Chinese companies. But actually CNH appreciated. And KWEB did dip, but the dip was for a few days, and it went up 40% since then. And we tried to show investors, like, listen, don't get shaken out of the trade. Tweets, headlines, newspapers, that's getting fed into a Cray supercomputer that is trading on this XBRL, this text that gets put into, ones and zeros, and just because the machines are trading doesn't mean you should be off of some of these headlines. And so hopefully it's for all of the folks tuning in, put CNH up on your screen, because it's a great intraday indicator.
Now let's go through here the China's weight in EM in this first slide. You see the red. That's the red increasing there. So, it's quite dramatic.
Yeah. So, I mean, this was if we went back even further, Larry, if you went back to 2000, in the year 2000, China was 6.5% of EM, even though it was 19% of EM's GDP. You jump to 2010, China's 19% of EM, but it's 29% of EM GDP. And today, China is 40% of EM, and is about just about 38% of EM GDP. So you had this disconnect as being rectified, which is China's economic weight hasn't been really applicable to the EM benchmark. And so I think there's a really strong argument, a pretty easy argument, on how China at 40% can be 50%, can be 60% of EM. I have the numeric holdings here, where numerically China's already more than 50% of EM. And I'm not saying this is right or wrong
in terms of number of holdings.
So there's not quite. It's about just over 1,300 stocks in EM.
Yeah.
So China's over 50%, and I think it's very easy to see a path. In 2015, 2016, MSCI added U.S. listed Chinese companies. So Alibaba, right, was added to the index. It's something that, not to pat ourselves on the back, but for KWEB, we did U.S. and Hong Kong listed companies back in 2013. It took the other index, MSCI and FTSE, several years. And then 2018, 2019, we had Chinese A shares. 20% of the potential weight of Chinese A shares added to the indices.
The A shares are the companies that are directly on land, right, in China, versus the other companies in the KWEB are a little bit more globally diverse, or how would you put that?
Yeah. So a lot of the kind of leaders have listed overseas in Hong Kong or the United States because they can garner a global investor base. The Hang Seng Index is 50 stocks, but there's 3,000 stocks on the Shanghai and Shenzhen. Taking 85% of the market cap of Shanghai, Shenzhen, gets you to about 575 stocks for Chinese A shares.
Okay. Why don't we go to the next slide?
So this is what really led me to wanting to be part of Crane Shares, and really taking John's vision and helping to make it investable. Was the exact thing was so this index has a trillion benchmark to it.
Is that a benchmark in terms of the size of the ETF and index?
So if you take all the passive and active funds benchmarked to MSCI emerging markets, it's $1 trillion in aggregate assets.
Okay, so all the funds that are benchmarked to the mothership.
Yep. And so because of the reforms, and I think an element, in finance, China's done massive reforms, and that's not true for every segment of the economy. So an element of our bullishness is reflective of we're in a sector where the handcuffs have really come off, but the Shanghai and Shenzhen stock exchanges as defined by MSCI. So KBA is this orange slice. It's our MSCI China A ETF. We listed it back in 2014. We were the first MSCI China A ETF globally. I think we were actually the first licensee of the benchmark. That MSCI back in 2013 was like, you're not allowed to invest in these stocks, but we actually convinced them to license the index to us. And in March of 2014, we listed KBA, our MSCI China A ETF, which represents this orange slice.
So that's the KBA, so that's the China A share. That's your version of the China A shares, the KBA.
Yeah, and we wanted MSCI's exact definition. We wanted to own the exact stocks that would be added to broader indices like EM. And there are other, ETFs and other China A indices, but again, we wanted to, be aligned with MSCI. Now they've only added 20%. Of these 475 stocks market cap. So there's 80% to go. So we can see that in the next, I think, 3 to 5 years, these the stocks in KBA will represent almost twice the exposure of other countries. And I know, I'll give you credit. We did a EMX China ETF, KEMX, just to say that, investors, you want to have exposure to other parts of EM, and you got to break out China. It's a phenomenon we're seeing. Institutional consultants today, Larry, are advocating, you got to break out China. And I think they've seen, what's going to happen in the next few years. And not to date ourselves, Larry, but, we saw this in the 80s where, Japan went from 30% to 60% of developed markets. And in 1989, MSCI did Asia ex Japan. That Japan was just dominated the benchmark. And I think the same thing is going to happen with China with EM.
You've done a Crane ex China fund already, correct? So you're kind of getting out in front of the indexes. Is that?
Yeah, so we have KEMX is this MSCI EMX China, and I think it's just China. We could debate all day. Is it a developed market? Is it emerging? And it's arguably both. Having been to the hinterlands outside of
how many times in a normal year? How many times do you guys go to China?
So I'm there probably quarterly. John's there, probably more frequent than that. It's part of having, you got to go. You just have to go, and we meet with the exchanges, the regulators, the companies we own. And seeing is believing. That it's an experience. Have you been to China, Larry?
I delivered a speech there after my book came up. So Colossal Failure of Common Sense is now in 12 languages. I tell my wife once a month, as a former Lehman trader, if we sell 1 million books, we'll break even on our Lehman stock. So make sure you buy it. It's an incredible book for young students in college, people coming up in the business. But it's now in 12 languages. It's sold about 650,000 copies, and we have 2 versions in China. And so I've been invited there a couple times now, and it was quite remarkable to be there in Beijing and launch the book. And it was a very warm reception. We sold a lot of books in China. I'm very grateful for that trip, and it's nice to have a book that where you can go around and see. You make more money on the speaking tour than you do actually writing the book.
China has I think it's like 130 cities with more than 1 million people. So you can do a big tour in China, Larry.
Next slide. Can we get the next slide here? Okay, there we go. So now we're talking about better control of COVID-19 led by faster work resumption. So this is one of our theses in the bear traps report this year was, number one, you're going to have a more dovish Fed, a Fed that's learned their lessons from the aggressive Fed in 2013, 2015, and 2018. That same Fed that blew up the global economy 3 times is going to be, is going to really try as hard as they can to arrest the dollar. That's number one. So we've been extremely overweight emerging markets, commodities relative to the U.S. In reports going back to April, bear traps reports. But also the other thesis behind that was that Asian countries have been through this COVID problem, these pandemics in Asia, so much more that work resumption when you go in first in, first out, number one, that's a powerful impact. But first in, first out in Asia countries that have been through multiple pandemics, the adjustment process is a lot quicker. The societies are a lot more mask friendly. And so the restart, the development of restarting with the vaccine, you think about the global economy, 82 trillion of GDP, 82 trillion of GDP in the world, and only about 20 of that's in the United States. So there's 62 trillion of GDP outside the United States. You just do the math. Vaccines have an incredibly powerful impact on that 60 trillion, more so than the 20 trillion in the United States, because there's just more economic activity outside. So first in, first out with vaccines, that gives you a real emerging market renaissance. And what do you see in this slide now?
Yeah. I mean, I think you almost have to give some element of a pass to the United States, Europe. We haven't had a real pandemic in 100 years, and unfortunately, in Asia, this isn't their first dealing with this. Starting with SARS in the early 2000s, but you've had a number of unfortunately pandemics, and the highly urbanized nature of Asia really is why they not only enforce the quarantines, but enforce the social distancing measures, but also wearing a mask is not frowned upon or doesn't become a political issue, and that allowed China to implement a very strong quarantine in the first quarter, and in a lot of ways, China, it's almost like a tell in poker that China's now almost full 3 quarters removed from their quarantine. And we can kind of, why we believe, if it's through China Last Night or craneshares.com, we produce a lot of research, is simply, it's going to, China's telling you what's going to happen in North Asia, which will be second in, second out, Europe, United States, a little further afield, and LATAM and India, Latin America, South America, India, a little bit further out, and so, one, China's been able to bounce back really, really strongly, first and foremost. And second,
of that, and that plus the Fed, really going out of their way to become a more socially responsible Fed. You've got inequality in the United States, so it's pretty clear that the Fed policy in recent years has been fairly disruptive in terms of inequality. Okay, so by being more common in theory, by being more accommodative and having a weaker dollar, that's going to protect more U.S. manufacturing jobs. That may give us a better overall longer term economic outlook in the United States. But if you take that along with the vaccines, along with, as you said, Asia first in, first out, it's almost like, the way I look at it, the global economy has been tremendously out of balance, because over 65% of all trades in dollars. So every time the dollar is ripped, it has just an incredible impact. I mean, if you're in Chile or if you're in Brazil, and these economies don't have big rail systems, and so if the dollar is making a big move, and at the same time you have elevated oil prices as we had, several years ago, with the dollar at a higher level, it's incredibly damaging for these emerging market countries. Massive deflationary impact. And so it's almost like what I think is happening now is the Fed has got the joke. At the same time, and reading your blog, China last night, you can see that Asian countries are coming out of this first in, first out. All of that with the vaccines, I think, gets you a 2 to 3 year outperformance of emerging markets relative to developed markets.
Yeah, I mean, something I've been thinking about, Larry. Be kind of curious your thoughts is, the global financial crisis, came to China. That it rippled across the globe, the global economy, and our economies are more intertwined than I think. But anyway, China's response was this massive debt-driven infrastructure boom, and the debt issue in China, which they've really worked to try to keep it from growing more. But I just wonder if, here it is a decade later, the Fed has expanded its balance sheet incredibly. The U.S. has a very expanded debt pretty dramatic. And, just as China kind of struggled with this kind of debt hangover, are we going to have something here as well? I mean, I'm not rooting for that, but I think ultimately, I see a lot of home bias in U.S. equities, and I think, if it's China and EM, it can play a part of a diversified portfolio. At the same time, I do wonder is the U.S., did we replicate a little bit of this debt-driven stimulus that China did, following the global financial crisis, and it took a while to work its way out of that.
Yeah, great point. Next slide. And then here we go. This is many U.S. companies derive a significant portion of their revenues from China's 1.4 billion customers. So yeah, wow, look at Win, Broadcom, Micron, incredible international exposure. This is the problem with the S&P, right? This is the problem with 2013, 2015, 2018 with the Fed. When you are hiking and pulling back accommodation more aggressively than the rest of the world central banks, you blow up these companies. You blow them up because the dollar strengthens. Close to 50% of the S&P 500 sales are outside the United States now. And so this whole thing with the Fed, and it just causes literally a boomerang effect. They tried to adjust monetary policy 2013, 2015, 2018, and every single time they tried to withdraw accommodation, dollar strengthens, and then these companies that are exposed to the rest of the world get hammered, and then that comes back and forces the Fed over and over again. This global stress from the dollar literally broke the Fed over its knee. 2018, the Fed had to reverse policy. 2018 in the fourth quarter, December. 2015, and it's almost like they finally got the joke. Now they're proactively trying to arrest the dollar, and that's very good news for these companies.
Yeah. I mean, I think for us, the media, a lot of these headlines. I mean, some value you bring, Larry, is you're a data-driven person, and it's analysis-driven. The media. There's a lot of headlines, and I think when it comes to China, some element of what we read is not fact-checked. It's hyperbole. It's misperception, and the end reality is, our economies are far more intertwined than I think is really recognized. And these companies, what's the real key point as well is that this 376 billion, and that this is from the New York Fed. It's not our number. That's manufactured and generated in China. So it's not doesn't show up in trade data. that if Apple manufactures an iPhone and sells it in China, it doesn't end up in trade data. The revenue ends up in Cupertino, but the definition of trade is really something put on a boat. And so U.S. companies are doing very well in China. And secondly, I would say that there's this idea of, well, we can just bring it all back. And one is these factories are in China and Asia because there's 4 billion people in Asia. And you put a factory where you have the most customers, and the U.S. has a population, what is it, like 360 million. If you're the CEO, where do you put a factory? Everyone wants to talk about lower cost wages, this, that. The end reality is Asia's got 4 billion people. The other issue is a lot, to the point you made earlier, Larry, it's, a lot of what the U.S. manufactures is high value. Those inputs, those basic inputs, come from China or Mexico, India. They're not high value, and ultimately, China's paid, like India's paid, a steep economic consequence for being that global factory of some of these basic inputs. And when I hear people say, let's bring it all back, well, okay, let's put a coal smelter in your backyard. It's never going to happen. That the environmental consequence, which China is trying to grapple with.
Well, that's the thing people don't understand is that these countries in the U.S. and in Europe, all they've done is export their green guilt to India and China, because at the end of the day, Nike, Apple, all these products, your underwear that you buy in Walmart, all of these products are made in manufacturing plants powered by very cheap coal. And that cheap coal, that gives you a very, very cheap electrical cost. And that's a big part of the profitability of manufacturing, is the labor cost and also the energy costs, right?
Yeah.
So this whole Paris Climate Accord just blows me away, because people don't understand. It's more about, we have a global revolution
Uh-huh.
where we really exported our green guilt to other parts of the world. But let's get into the next slide.
I think we failed to educate a lot of these workers who they weren't prepared for this. But that's a whole nother topic.
Yeah, we definitely weren't prepared for that. But next slide. But one of the points I've made, Brendan, is that the 2016 election, I'm convinced that when the Fed over and over again tried to adjust monetary policy, withdraw accommodation, the dollar ripped, and it definitely had a huge impact on U.S. manufacturing jobs.
Yeah.
In other words, when the dollar moved up, and we did the math, and it's literally probably, I think we counted about 340,000 manufacturing jobs 2016. So as the dollar ripped 2013, 14, 15, 16, as you were heading into the 2016 election, Michigan, Wisconsin, Pennsylvania, those states lost a ton of manufacturing jobs. And and as you can see here on this slide, so this is your the KWEB, not the KWEB, but the Crane ETF, the KEMX, ex-China. This is fascinating. So you've got a big reversal here of emerging markets. So with the Fed, here's the big picture. The Fed's contained the global wrecking ball that is the dollar. You have vaccines coming. You have a global economy with 82 trillion of GDP, 62 of that's outside the United States. And you have this real renaissance in Asia. These countries are coming out of COVID faster than the United States. And so as you can see here, this is a significant, everybody talks about growth to value. Like that's getting all the headlines because you're seeing a lot of really some tremors before the quake, what we call the bear trap support. Yep. But we've seen like 5 big tremors the last 6 months where money's moving from growth to value. But the second part of this story is the money moving from everybody hiding out in U.S. stocks because of Brexit's 2006, 14, 15, 16, Brexit, trade wars, COVIDs, everybody driving assets into the United States, driving assets into dollars. And so now all of that flow, trillions of dollars are flowing right now as we speak over the next couple of years. A couple $1 trillion is going to leave the United States, and this chart shows it's flowing into emerging market equities quite powerfully right there. And there's a big bottom, and that's a 1.5 year chart, 3 year chart. So that's a significant move. Any comments here, Brenda, before we?
Yeah. I mean, I think you bring up a good point. This value growth debate, and I think the value growth that is a global phenomenon. That growth companies within the EM have done very well. The Alibabas and Tencents. Taiwan Semi is a massive holding. So I think you're going to have kind of two interesting things, which is the EM benchmark. If you want to eliminate value, the growth, if you think of commodity rebound, the EM benchmark is not a great transmission engine for that. EMX China is a better version for that. It gives a lot more weight to the LATAM, South Africa.
Exactly.
And so I like the EMX China. It's I think in China there's a lot of things going for it in 2021. I do think the value growth disparity has gotten so wide, and I do think the baton going to Asia, LATAM, India, provides a great reason for owning KEMX.
Yes. Our big. Well, we've been pounding the table since like April, May, June. Is around not just commodity equities, but commodity producing countries. And your two workhorses there, Brazil and Chile. Chile's the largest copper producer in the world. And so we think in the bear trap support, the commodity producing countries will outperform the rest of EM and probably very well outperform US equities in the next year and a half, 2 years, 3 years. Next slide. Okay, here we go. So this is an incredible. This is the global wrecking ball that is the US dollar. So as you can see here, the inverse relationship of the dollar and central bank policy at the Fed. Today's a big day historically because the Fed, is trying to arrest this problem. And the problem is when you blow up the global economy, you're blowing up 62 trillion of GDP. And that feeds back to the United States, and that reverses whatever central bank policy you're trying to accomplish. So if you're trying to reduce your balance sheet, if you're trying to hike interest rates as they were in 2014, 15, 16, 17, 18, they were reducing, obviously, they were hiking rates and reducing the balance sheet in size. And net each time that caused these dollar moves, and each time those dollar moves created a substantial impact on emerging market equities. And this is each time you can see here with the dollar, they're just massively inversely related. And on the far right, as you can see here, the Fed is trying to contain the beast that is that global wrecking ball that is the dollar. And as they have, that is one of the most spectacular performances of emerging market equities relative to the U.S. in the last literally 20 years, in a very short period of time. And it's almost as if all the allocators globally have just woken up over the last 2-3 months and said, we are underallocated in emerging markets. We have to fix this. EM still is trading, correct me if I'm wrong, I think EM bottomed out at 12 to 13 times earnings. Maybe now it's 14 times, 14 and a half. And the S&P is trading 18, 19, 20 times, depending if you look at current versus forward. So EM equities and some developed markets like the UK are trading so much cheaper than the US. And I think a lot of people are waking up to this because without the dollar, that strong dollar impacting asset flows, then it's going to come back to valuation. And that's where I think that's where you're going to have a big renaissance here in emerging markets the next couple of years.
Yeah, year to date, Larry, U.S. listed EM ETFs have lost $3 billion.
So $3 billion of U.S. listed ETFs that are we're talking about the people that were, because of Brexit's trade wars, that were trying to hide out in the U.S. Now that money's $3 billion left.
Well, left EM. So I think a lot. This move's been so quick in some ways, but a lot of people have missed it. That
was so. What caused most of that was obviously the Brexit and the trade war and the COVID in the first quarter. So that you had like a huge outflow. Most of that outflow was, you can see right there. God, I mean, that was an incredible outflow, and it's almost like people figured out, oh my God, it's probably the same year. You've got record outflows now. We'll finish the year. We'll probably get the data next month, but you'll have record inflows, in the fourth quarter. But last slide before we close it up. But it's been a great picture, because with your strengths in passive asset management in Asia, and then overlaying that up with a macro view, it's really important here. That's why I always look at one of our great indicators globally. I always look at Maersk. This is the largest shipping company in the world. And if you can see there, technically the yellow is a multi-year down channel. This is a phenomenal leading indicator for emerging markets, for global equities. And Maersk there is just, and then here, we wrote a blog, had 1 million views, called the Cobra Effect. And all the Cobra Effect is when you have a central bank policy that's very accommodative at the same time with the fiscal of, say, total $4 to $5 trillion of fiscal and monetary accommodation in a very short period of time. You create these global imbalances, and then you have supply chains that are obviously messed up because of not only COVID, but the trade war. And the whole thing just sets up for a recipe for some very wacky price discrepancies. You can see here container freight rates. The big containers are, with COVID, you had to take a lot of containers offline, and then you had the fiscal and monetary, the 4 or 5 trillion. Actually, it's much more than that globally. It's upwards of 10 trillion globally of fiscal and monetary accommodation. So then all of a sudden that kicks in. And as you can see here, imagine trying to run one of these shipping companies as you have the horrific COVID impact suppressing global trade. Before that, you had a trade war. Before you had that, you had Brexit. So you have this massive suppression, and now you have this 10 trillion of fiscal and monetary accommodation coming out of the Fed, the ECB, the European political fiscal policy, Asia fiscal policy, U.S. fiscal policy. So it just creates a Cobra effect where, back in the 1800s in India, they tried to suppress these cobras were running all over these cities in India, and they said, "We'll give you 1 or 2 pounds for every cobra you can find." And lo and behold, many people went out into the countryside and captured the cobras. But unfortunately, some people started to breed the cobras, and they were selling the cobras back to the government. And this is just classic unintended consequences.
Yeah, that's great.
You create a government policy when you're trying to correct a problem. You're paying for the cobras. Then people started to obviously breed the cobras. Then all of a sudden you had twice the amount of cobra problem that you had before. And then they had to cancel the policy. And then all these cobras are running wild. So it's just, when you look at fiscal and monetary policy in emerging markets and global equities and the dollar, you always have these unintended consequences. And right now we are in the throes of this. And this is going to literally reverberate through the global economy. These asset flows and this rebalancing of the global economy relative to the previous decade was all about taper tantrums and austerity, and then Brexits and trade wars and COVID. So all of these factors were extremely deflationary. I mean, just literally like 7 factors in a row. In the United States, we had an incredible austerity after Lehman. We had the original fiscal 800 billion that I wrote about in my book. But then by 2013, we were in this, really 11, 12, 13 incredible austerity period in the United States. And so, and then the same thing in Europe, you had austerity with Greece, austerity in Italy, and then you had obviously the Brexit, and then you had COVID and the trade war. So all of this really drove tons of assets, trillions of assets into the United States the previous decade, 2010 to 2020. From 2020 to 2030, because of this Cobra effect and the central banks and fiscal and monetary response globally, it's going to be really just an incredible amount of asset flows outside to the rest of the world. And all of that money that was hiding out in the United States is now going to migrate to other parts of the world. And I commend you at Crane Shares for being in position, because I think that your best days are ahead. But Brendan Ahern, it's been a pleasure to have you on the hot mic with Larry McDonald, the Bear Trap Support. And it's great to talk to an old friend. And I'll see you at the top, and let's do it again in a couple of months.
Sounds great. Thank you again, Larry. It's great seeing you as well.
Okay, all the best.